You know how Wall Street has slang for pretty much everything? Well, there's one acronym that's becoming absolutely essential for anyone trying to figure out the crazy intersection of politics and the market. It's called TACO. And no, I promise, it has nothing to do with food.
So what's it stand for? Well, it's pretty provocative. Trump always chickens out. Now, look, this isn't just some clever nickname. For traders, this is a shorthand for a very specific pattern they think they've spotted, and we're going to break down exactly what they mean by that.
Let's be super clear. This isn't a political label. For the folks on Wall Street, TACO is a theory about how the market behaves. It describes this cycle that they see as predictable. First, a really aggressive policy threat gets announced. Then the markets and business leaders freak out and push back. And finally, the actual version that gets implemented is, well, it's a lot weaker.
What's really interesting is how traders have mapped this whole thing out. It's like a simple three-step dance. Step 1, the aggressive threat. Some bold new announcement drops and creates a ton of uncertainty. Step 2, the market and business pushback. You see stocks dip, you hear industry groups lobbying hard. And then Step 3, the policy softens. The final rule is either delayed, watered down, or just filled with exemptions. So where in the world did this idea even come from? Well, it was actually born during all those tariff negotiations in Trump's first term. The data from that era is what gave traders the proof they needed to coin the term in the first place.
And you can see the pattern so clearly when you look back at the tariff data. For our USMCA partners, there was this initial 25% tariff threat, which was ultimately paused. A proposed 10% global tariff, it got softened with a bunch of major exemptions. A 50% threat on the EU, the deadline just kept getting extended. And this one is wild. A massive 100% threat on semiconductors, it was negotiated all the way down to around 15%. In every single case, you see it: threat, pushback, and a much softer outcome. And get this, it went even further than that. Some of the most extreme threats, they never even happened at all. There was a threatened 200% tariff on European wine, for instance. It just never came into force. Other big plans were simply blocked by the courts. For traders watching all this, the takeaway was obvious. What you hear in the headline is not the final reality.
But look, this isn't just some history lesson. Investors are using this exact framework right now, in real time, to try and predict what's going to happen next.
For example, let's take the January 12th announcement of a new 25% tariff on any country that trades with Iran. I mean, that is a massive, aggressive threat. So for traders, this is a live test of the taco theory. They are watching like hawks to see if that familiar pattern, pushback and then softening, is going to repeat itself.
And that really brings us to the crucial question of the day. The whole theory was born from international tariffs, right? But now traders are asking themselves, is the same pattern going to hold true for a totally different ballgame, domestic policy?
And the new testing ground for the taco theory is what's being called Trump's 2026 affordability push. It's a whole series of proposals that are aimed at tackling the rising cost of living for Americans. Okay, first up is housing. The big aggressive threat was a ban on large investors buying up single-family homes. But here's where that potential softening might come in. Analysts are quick to point out that institutional ownership is actually a pretty small piece of the market. And, more importantly, a ban like this would require a brand new and probably very difficult law from Congress. Next, credit cards. The proposal? Let's cap interest rates at 10% for 1 year. The pushback from the financial industry was, you guessed it, immediate. They warned it could actually make it harder for people to get credit, especially those with lower scores. And, just like the housing plan, this would need to get through Congress. See a pattern here?
And the push is even broader than just that. It includes ideas like stopping defense contractors from paying out dividends, and there's been talk of intervening directly in the mortgage markets. The theme that ties it all together is this idea of taking on what's described as corporate excess to lower costs for everyday people.
Okay, so we have this theory, we have these examples, but how does this actually translate into a trading strategy? For investors on Wall Street, how does this pattern become, dollars and cents? For an investor, that TA cycle we talked about looks a little different. It's more like a playbook. Step 1, the headline hits. It sparks fear, and stocks in whatever sector is being targeted sell off hard. Step 2, they wait. They watch for the pushback and look for any little sign of clarification or softening. And step 3, if the policy gets walked back, the stocks rebound, and that creates a potential buying opportunity. And we have literally seen this play out already. Right after those affordability announcements, stocks for credit card companies like Visa and Mastercard dropped.
Real estate firms like Lennar and Pulte took a hit, and so did defense contractors like Lockheed Martin. The initial fear was very, very real. One source really just nailed the entire trading philosophy perfectly with this quote. The gap between headline fear and policy reality is where long-term profits are often made. The whole strategy, when you boil it down, is to trade the uncertainty itself. So, after all that, what is the big takeaway here? Is this taco theory a reliable pattern that can help predict what the market's going to do? Or is it just a high-stakes gamble every single time? Ultimately, taco is a mental model. It's a framework that helps traders see these big, aggressive threats, not as the final word, but as the opening move in a negotiation. It's their way of pricing in the chance of a reversal. And that leaves us with the ultimate question, doesn't it? Is history a reliable guide here? Does this pattern offer a truly predictable opportunity for investors? Or is every single new policy announcement its own unique political gamble, where maybe, just maybe, the old rules don't apply? That is what the market is trying to figure out right now.